Good morning, everyone. I'm Vince Lancy. It's 7:42 in the AM. This is the Gold Fix Market Rundown. There's the home page. We're going to be talking about on the lower right a post that just went out titled Mini Pod. Deutsche Bank says a majority of BRICS gold buying is secretive and growing. Essentially, Deutsche Bank flags unreported China-Brics gold demand as not just a major driver, but as a widening gap between the West's perception and the East's reality of what's going on. There's the home page. Are you ready for $144 silver and $9 copper? That's the math on when you take metals and you make them critical, assuming that there's no global recession. Uh, but that's the math. You can take a look at that. Top left-hand corner, founders. Tide reversal is here. Range breakout may come. That's about gold, and we're just going to share this with you. That's from a bank's trading desk, and they note the impulsiveness of the buying that came in after the payrolls had backed off, but then they noticed it came back with a vengeance uh, last week. And so I think their tentative conclusion is the buying isn't touristy, it's going to stay here, and it's anticipating 25, maybe even 50 basis points in cuts. And then there's various analysis in there. Okay. Looking at the markets, 10-year yields are unchanged bid at 426, 427. The dollar is 98.69, up 47. Seasonally speaking, between now and October is generally speaking bullish for the dollar. If you're just factoring everything out, for some reason, the dollar goes up during this time of year, which is something that would hang on gold and would explain sell season, which is starting soon for gold. The S&P 500 is 64.71, unchanged offered. The VIX is 14.79, stable. Gold is 33.74, down 18. Silver is 38.20, down 38. Both of them are on the lows of the evening so far. Copper is 439, down 6. WTI is 64.03. Dead cat bounce up 11. Natural gas 271, down 2. Bitcoin down another 550, 111 and change. Ethereum still holding its own at 4,600. Palladium 1090, down 10. Platinum down 9. Gold, silver 88, creeping higher. Grains are mixed. Soybean bucking the trend higher. You look at that and you see another recessionary situation, a recessionary situation where the market is discounting economic slowdown. And so you're seeing uh, industrial metals weaker. You're seeing WTI, it's 10 cents higher today, but it was pretty much drubbed yesterday. And so you have to think, if you're purely a gold and silver person, you have to think gold and silver will be weighed down by this as long as there's no news or ideas coming out that will uh, prod the Fed to be more aggressive in their cutting. So there might be some data out last night that's recessionary coming out of the East. That's one. There's definitely a movement in the East into stocks, tech stocks specifically. So that would be a little bit of cannibalization of Eastern demand, of Chinese demand. And the third thing is China and France. They're probably going to become wards of the IMF, one of the two of the countries that helped create that disaster. So there you have it. Emerging markets used to use the IMF, and now we can just call them submerging markets, countries in the G7 on their way down that are using the IMF. They could come for everyone eventually. Wonder what Germany's thinking right now. Okay, let's get to our story. Deutsche Bank highlights the failure of traditional financial models in gold and points to unreported central bank demand, led by China, as the new driver. Deutsche Bank's latest gold analysis, in our opinion, highlights three core themes reshaping the market. First, traditional financial models linking gold to dollar correlations have failed in 3 of the last 4 years. This is something that we've been reporting with correlations for the last 3 years as well. The report attributes this structure change to the freezing of Russian central bank assets after 2022. Another thing that I think is not surprising to us, which undermined trust in dollar reserves and reinforced gold's role as a neutral asset, accelerating de-dollarization, which started in 2009, really. Second, the bank emphasizes the scale. This is the headline. Second, the bank emphasizes the scale of unreported official demand. Charts show a widening gap between reported central bank purchases and actual flows, with unannounced buying now dominating by a 3-to-1 ratio of the actual buying. This dynamic is heavily driven by China, and it renders the IMF and World Gold Council data increasingly irrelevant, like the old mall you used to go to. The erosion of Western reporting standards, we believe, signals a further weakening of institutional credibility and shifts liquidity eastward. Self-reinforcing trends are at work here. It diminishes the LBMA's centrality even more. Third, and not the headline, but something that we focused on, Deutsche Bank revisits the legal ambiguity around freezing Russian assets, talking about Europe's perception of how that's going. There are ongoing, this is like a lawyer thing, right? There are ongoing attempts in Europe to retroactively legally justify their actions, freezing the assets. And for me, I mean, well, actually, Deutsche Bank says this. For that should raise concerns of non-G7 nations and reinforce their incentive to accumulate gold. Oh, well, if they succeed in legally justifying confiscating Russia's wealth or freezing it, whatever the actual word is, well, then I guess they could do it to us anytime they want. Deutsche Bank also forecasts gold averaging 33.50, which is, right about where we are in 2025, averaging, and reaching 3,700 in 2026. Their tone is cautious, in our opinion, yet clearly bullish, contrasting with more aggressive forecasts from peers who like to say it's going to 4,000, and then if they're wrong, they push to 4,000. They don't change the target, they move the time out. Deutsche Bank is relatively new on the scene. Again, having been a major player that was caught with their hand in the till, they want to be completely square, I think, and regain influence in the world, particularly in Asia, where things are fresh for them. They're acknowledging the structural realignment of gold markets for sure. The full analysis for that report is in Deutsche Bank says the majority of BRICS gold buying is secretive and growing. The link is included there. And we have a special mini pod running through things in a lot more detail with some examples of how different banks are reporting on this. Moving on. Related posts. Are you ready for $144 silver? Fingers crossed. Not today, but you get it. Critical mineral analog for silver and copper, Goldfix PM, and cooked by state capitalism. Those are the stories we sent out yesterday. Coming soon. Moran's Mar-a-Lago gold plan revealed. We'll come back to that. Replacement migration was part of the plan. That's a story that we have ready, but we held off because of the silver being critical mineral listed. And the last one is America's two paths through anti-Goldilocks. I want to touch on Moran's Mar-a-Lago gold plan. Pundits, I guess I'm a pundit now, right? People who read the title of the Mar-a-Lago plan and decided to talk about it said, it's bearish the dollar, it's bearish the dollar, it's bearish the dollar. Yeah, it is bearish the dollar because we need to weaken the dollar to sell stuff overseas. What it also is it's not bullish gold. See, Stephen Moran wants to monetize the gold by literally selling it. It says it right in the plan. So we actually wrote a paper on this, an academic paper on this, describing how it would happen, how it could happen. Now, is it bearish gold? No, I don't think we're selling the gold. We're not going to do that plan. But keep all this in mind when you see Moran promoted to the Fed, which is connected to the plunge protection team. which is in his report, the Mar-a-Lago report, and you see the whole thing about we need to reduce our debt. How are we going to do that? Well, we could sell the gold. I don't think they'll do that. That's suicide. But we can hedge the gold, and I think I think we're going to have a big crack up in gold. Not tomorrow, but we're going to have a big crack up in gold. There's a revaluation thing that's happening now, I think a lot more. And after that happens, I think the US will start hedging again. And what's my evidence of that? Well, I'm already seeing producer hedging. I just want to say this to you, when someone tells you the Mar-a-Lago plan, tell them to shut up and read it. The last story, America's two paths through anti-Goldilocks. We wrote that and we held off on it. It's something we coined the term anti-Goldilocks. We coined that 3 years ago and was picked up by a Goldman head trader. But since then, no one is mentioning the word anti-Goldilocks. But the concept of anti-gold, we want to mention this to you because it's kind of important. It's what we're in it right now. The anti-Goldilocks concept is this. The Goldilocks concept, which everyone loved so much to talk about, was low inflation, high good economy. And that was a result of China lending us money, but equally or more importantly, it was the optimization of supply chains. Remember, Walmart prices were dropping, all the goods prices were dropping for years in the 90s. And that was the benefit of squashing inflation in the 80s by Volcker in combination with the globalization of our supply chains. And we benefited. That was Goldilocks, just right. Inflation was low, standard of livings were going up. And it can be quantified in one sentence that Zoltan Pozsar had used. He said, in the 90s, disinflation was a tailwind. It was pushing us, right? Things you couldn't do wrong because we were taking interest rates from 20% down to 3%. At every step of the way, the Fed could lower rates and not have to worry about major repercussions because the economy was being bolstered by basically we took our medicine. Now that's flipped. The world's deglobalizing its supply chains. That means all the stuff we get for cheap from China that goes into Walmart ain't so cheap anymore. It also means we have to build our own manufacturing. We have to drill for our own minerals. We have to drill for our own metals. So that disinflationary tailwind that was pushing the markets higher now is an inflationary headwind. Hence,